Good morning, I'm Gary Evans, the Chief Innovation Officer at OpenWorks, and today I'm joined by Bruce Curry, who's Vice President of Credit Risk Collections and Recoveries at FICO. Today, Bruce and I are going to share some insights on the financial symptoms of COVID and what the outlook is for the people affected. Bruce will start by looking back upon previous financial crises and what we can learn from what they meant for consumer behaviour. Then I will talk through what we've seen from our tele customers during the first wave, what differences I think we'll see from the second wave, and what the impact of payment holidays will be for Joe Average. Then I'll pass back to Bruce to cover off what creditors should expect to happen once the crisis has ended and what they should look out for. So without further ado, Bruce, I'll hand over to you.
Thank you, Gary, and good morning, everybody, and thank you for spending some time with us. It's going to be a bit of a whistle-stop, so next slide, please. First of all, and this slide will build out as I'm talking to it, so don't worry about that, but in short, there's been 81 financial crises around the world since 1991. Everybody seems to only recall the 2008 global financial crisis. The mean average of the NPL impact is that post whatever triggers that crisis, the economic side of it is that the NPLs will typically multiply by 2.9, nearly 3 times. That's been the mean average of all the different crises. What we're already seeing from H1 figures from some of the tier ones around the region is that multiplication is already looking like it's going to be on the right-hand side of this graph. They're already hitting 4 and 6 times pre-COVID NPLs appearing in their portfolios. Next slide, please. And the other thing, this will build out also, the other thing that I also think is interesting is how everybody seems to be talking in very near-term terms, as in, you know, when the lockdown finishes, when lockdown 2 finishes, when the payment relief finishes, now that the vaccines are here. These impacts on the economy have a very long tail. A month before COVID struck and it became known worldwide, I was with a Southern European government talking about how they were going to work down 12 billion euros of NPL debt that was still hanging over from the 2008 crisis. This stuff hangs around for a long time, and we will see the re-emergence of words like toxic assets, bad banks, and special purpose vehicles. So it's all about how, especially in an IFRS 9 world, which most of the region other than North America and Canada are subject to, it's all about how do I manage down and prevent the hemorrhaging of these future good customers that are going to reach NPL status, no doubt, on my balance sheet. Next slide, please. I need to be looking for, you know, what will this financial disaster result in terms of financial difficulty for my customers? What will be there that I'm actually seeing or looking for? And this is lessons learned from past crises. So the first one that comes to mind is payment hierarchy. Everybody seems to look back retrospectively and say, oh, look at that, the payment hierarchy has changed on these products with these customers when I look back. But actually, it's a lesson learned. We know they're going to change their payment hierarchy. We know the things that influence that change in the customer's mindset. It will be the imposed regulation. It will be what the industry offers. It will be what the consumers themselves as a group start to expect. And as those things come to bear in different markets, in one market you'll still have to clear that mortgage. In another market, you'll be able to not worry about your mortgage because the regulator will say you can't, you know, the creditor can't take you home. All of those things change the payment hierarchy. The next thing that we learned from many previous crises but typically fail to act on is the return to financial good. Economic victims, those are the people that wouldn't be in collections were it not for whatever triggered the financial crisis. In this case, it's COVID. So all those customers that would not have ended up in collections are really economic victims. They have a very different return to good profile than normal steady state collections customers. An awful lot of organisations don't go looking for that profile. They don't adjust their policies for it. They don't gather additional data so that they can treat them appropriately. And they actually hemorrhage an awful lot of future good customers. They lose them out of the book, not recognising that they have a very different financial morality. And as I say, they will perform differently. 2 years pre-2008, the average return to financial good on purchased debt was 2.5 years. 2 years following 2008, that had reduced to 0.9 years. The reason for that counterintuitive reduction was there was a significant proportion of economic victims in the portfolios that were being sold. They have a very different financial morality and want to return to their previous standard of living and servicing of their debt that they enjoyed. The other thing we see an awful lot of, but again, don't necessarily strategize for, but we can actually model for these, we did in the last crisis, is strategic defaulters. These are the customers that want to take advantage of the regulated or the creditor tolerance that's being offered to all those around them. And despite them not needing the payment holidays, they don't see why they shouldn't take advantage of them. They then cause an over-indebtedness problem for themselves, and they certainly cause a strain on capital for the creditors. And then the last one isn't so much about the customers, but it's about our own operations. And prior to IFRS 9, we had the luxury of laziness. If accounts rolled through the cycles, we know that we could always catch them, and providing we got them before they defaulted or were charged off or written off, then we could probably release the impairment of them and just go down to a general provision. We don't have that luxury anymore under IFRS 9. And so if we're not really good at understanding which customers, A, shouldn't be there because they're a strategic defaulter, or B, will return to good quickly, then we're probably going to work everything all as though they're the same and end up with accounts reaching 31 days past due, stage 2, and 90 days past due, stage 3, and incurring the significant adverse impact on the balance sheet from our IFRS 9 reporting. So they're things to watch out for. We need to get our heads around them. They will be there. They've been there in every previous economic crisis. Next slide, please. When we entered into this one was unique because the whole world was impacted all at the same time, almost all at the same time, or certainly within a very tight window. And so I remember with colleagues from Openwork talking about the early phases of kind of repair and nurture and resolve, and we were looking at a tactical phase and a midterm phase and a long-term strategic phase. Please click. But the reality is that it's all turned out differently. It's coming and going. We've got lockdowns at differential paces and durations. We've got differential payment protection schemes and durations, likewise small business protection and continuation loans. So across the region, this is just going to bob up and down until we get to whatever becomes the steady state norm. So really, this is all about agility, data analytics, processes, strategies, everything, the operating model. It will all be about agility, more so now than any of the previous crisis. Next slide, please.
Thanks, Bruce. Now, since March, Tally has been using open banking data through My Budget from Openworks to provide consumers with affordability assessments that they can share with creditors to help determine what type of payment assistance they require. Now, what we found is that during the first wave, consumers fell into one of three categories. There's a significant population whose finances have not been negatively affected, although admittedly their mental health care and freedom have been. So those in the public sector, those working for strong corporation organisations, and those receiving pensions or benefits as their only income have been spared the additional budget strain of reduced incomes. But that leaves a significant portion of the population for whom COVID has had significant financial symptoms. Most of those furloughed and the self-employed with 3 years of tax records were able to limit their reduced income with government income support and balance the books with a combination of savings and payment holidays on key bills, plus the reduced spending forced on them by lockdown. In Tally, we saw a 55% reduction in childcare costs and a 65% reduction in transport and travel costs, with many people either not working or working from home. Whilst this has somewhat been offset by increased grocery bills, the reduced ability to go out and spend on social activity has meant that there's been a net reduction in outgoings as a result of COVID. Also, payment holidays, which have broadly been offered, have saved homeowners on average between £600 and £900 per month. And the combination of these factors means that the majority of people in this segment has been able to maintain their lifestyle, at least temporarily, throughout the first wave. The third category covers those who are on 0 hours contracts, relied upon the gig economy, were recently self-employed, or who have lost their job and not been able to find new employment. For these people who have lost the majority of their income, COVID has caused significant financial hardship. Many of these people who have fallen through the gaps in the government support net are also renters, which have not seen the same level of payment relief as with mortgages. So a larger drop in income plus a lower reduction in expenditure has meant that the third category has always been disproportionately impacted by the first wave. Next slide, please. Unfortunately, the second wave is going to be felt harder by everyone still impacted. Currently, payment holidays are limited to 6 months, which many people have already received. And whilst their income is still impacted, they're not going to be able to go back to full payment, which leaves them in a very difficult position. I do expect the FCA to direct financial institutions to increase the number of payment holidays that can be requested shortly, but these holidays are the only reason many people have stayed afloat. Another factor is energy. Energy consumption has been higher than normal during the summer due to people being at home more. And it's estimated that the winter quarterly bill will be almost £110 more on average for this very reason. Now, some people will be protected from this increase by fixed direct debits, but when their direct debit adequacy is reviewed, these customers will see their DD rising sharply to cover both their increased consumption and also pay back the arrears they've accrued. The third factor is savings. What savings people had will have been stretched by the first wave, and so the resilience to reduced income will be far lower in this second wave. Whilst the government have flattened the curve for unemployment rises by extending furlough again, more and more people are finding themselves moving from Category 2 to Category 3. And the budget deficit resulting from receiving universal credit will not be something that many families who are used to a higher standard of living will be able to manage. It's fair to say that the longer this goes on, the harder it will be for those affected. Next slide, please. And the bad news does not stop there. Even when we're through the crisis period and people's incomes are back to normal, there will still be after effects to deal with. Many people would have relied upon payment holidays to balance the books without worrying about the consequences. But as you'll see, the impact of these payment holidays on the post-crisis budget can be significant, especially for those that were already just about managing. Meet Joe Average, who took payment holidays out for 6 months on his mortgage, a credit card, and his energy bill. Across the 6 months, Joe increased his debt load by almost £3,400 due to compound interest being charged and the consumption of energy. If he restructures his mortgage and maintains the original term, it would result in additional payments of £44 a month for the next 14 years. Paying off the increased interest from the higher balance on his credit card will add £7.51 to his monthly minimum payment, and it will take a lot longer to clear. And repaying his energy arrears will cost an additional £50 a month, excluding any increased costs from being home more. So after 6 months of payment holidays, Joe finds himself £101 worse off each month, even if he gets back to what he used to be paid. With the government having to recoup some of their enormous economic costs of the crisis, it's also likely that Joe will see more of his income disappear through tax increases, making it much harder to balance the books going forward. And on that cheerful note, I'll pass back to Bruce.
So what do we know? We know from the global financial crisis, one out of the 81 I mentioned, that these poor performing portfolios of collections customers have a long tail on them. There is a direct correlation between the performance of the NPLs in a particular economy and their own economic recovery rate. And we need to, have the data science in place to be able to do that macro and micro analytics that understands what's going to be influencing. And there's already been a lot, this one more than before, there's been a lot of discussion around the level of data science needed in order to head off those NPLs, in order to put the right forbearance in place, because we all know that this is very industry sector driven. The recovery on this particular crisis is going to be very industry sector driven. And so organisations will need to get close to that and close to understanding how their economies are moving forward by industry sector so that they can relate those to the consumers that they've got on their books by those industry sectors. Next slide. We know from the McKinsey survey, which was only done in July of this year, that a lot of organisations have either been pushing on with their digital, their decision science initiatives and transformations, or if they weren't, they've recognised the need for them. Those organisations that had digital platforms, omni-channel platforms, remote decisioning in place, able to automate an awful lot of the customer journeys and user cases, and to bring AI and real-time decisioning into play, were able to adapt and adjust much quicker than those that were still or those that didn't have those capabilities. So that's going to be a big focus. It's massively being driven at the moment. It's all about how can I get insights on customers that I'm not used to seeing, and what channels can I use to engage with those customers, and what user journeys and user cases, customer journeys and user cases can I enable and facilitate through my technology and operations. Next slide, please. So what should we look at post-crisis? If we push through these as they come up, just keep clicking slowly. So MPV longevity, frequent qualification, using the open banking, using any data sources possible, and using the analytic tools to constantly keep monitoring how these customers are performing, what they're going to need, when, and it's not just about when they need more tolerance. As I said, it's going to have a long tail. So sometimes this will be about, hold on, this customer's circumstances seem to be strengthening. I wonder if they'd be now willing to restructure to recover some of the ground that they lost. Can I reduce their cost of credit for them? Can I pull back on that term extension I gave them? Yeah. Are they in a position to service this debt better than they were maybe 6 months ago? So that frequent qualification. We're going to see irrational spending and, as a consequence, credit consumption. People haven't been able to go and spend and do what they normally do, and we need to keep an eye on that and just see how that's panning out and where that credit consumption is coming from. Next, please, keep going. The masking of true risks, so customer education. Some customers will appreciate they're at risk and look at how they manage their household wallet. Others will be, we know this from the likes of Step Change, Pay Plan, and many other of the not-for-profit and for-profit debt management companies and third-party servicing sector, that many customers will mask their true risk. They'll call on savings, or they'll try different methodologies. They'll use expensive credit vehicles when they should be using cheaper facilities, etc. So there'll be a need for an awful lot of customer education. A survey of many years ago, highlighted that customers that weren't used to being in collections get extremely confused the moment they enter there. And something that I learned a long time ago, if you ask your data science team, just please, can you keep me updated every time you see the presence of the abnormal or the absence of the normal in any customer behavior by cohort, yeah, then that's going to trigger a need to look deeper. Next slide, please. We need robust expectation on the affordability and analytics. So, this whole Open Banking Expo is about getting access to that data, encouraging that take up, educating as to why we need it, what benefit it will give the customer, as well as what benefit it gives us in being able to help them out. Remove the potential for friction. So, don't have excellent data science and then a real problem getting hold of your customer and serving your customer and keeping your customer updated and having a natural adult conversation across multiple channels with your customer. There seems to be some concern at the moment about what you can proactively discuss with customers. Actually, they're typically very grateful for help, and they're very grateful for feeling that somebody's got their back. They don't expect it to come from the creditors. They're pleasantly surprised, and it generates a lot of loyalty when they receive it. Next one, please. Agility. I mentioned it earlier. Anything that's not automated and anything that requires going into the IT department for a 12-week prioritization before it can be adjusted is probably not going to help you out. You need agility. You need configuration, not customization. You don't want coding. You want rules, and you want to be able to adjust things around, and you want to be able to deploy your analytics quickly as well as things change and as these different cohorts come to the surface. And invest in real loss mitigation. So really focus on, how am I going to keep my future good customers? Hey, data science team, tell me who is only here because they're an economic victim. Ask myself, am I treating them differently? Am I engaging with them differently? Have I truly got the kind of solutions I need? Or am I going to sell them at some ridiculously low price a couple of years down the line to a debt purchaser who's going to simply do all the things I should have been able to do, and create great value for those customers? So there's a lot there. As I say, I'm sure this material will be on demand, but all the things that we should be focusing on whilst trying to keep the lights on and the the operation running.
Thank you on behalf of Bruce and myself. I'm from OpenWorks. Please come to our stall. I believe there's even an Apple Watch up for grabs if you talk to anything open banking and affordability basis. And if you don't know FICO, they've been around for 60 years and have been dealing with data and analytics products and will be available anytime you want them.